You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of Inc. Research, Canada's first online financial news and research service. Welcome to the show, Ted.
Well, it's great to be back, Jim, and Happy New Year to all your listeners. And we'll hope that in terms of the rest of the year, that the markets will provide a bit more opportunity to make some money, at least for those who are having to deploy money on the long side of the stock market.
Wow, the numbers that we're seeing at the start of the year are pretty scary. Oil down 16% in just the last 12 days. And finally, I've seen the prices at the Vancouver pumps actually reflect that. Well,
with the Western Canadian crude collapsing to below $20, even the loonie challenged Canadian gasoline market had to succumb to some deflation. I say loonie challenge, of course, because while U.S. dollar price oil is going down for Americans, going up for Canadians because our loonie is falling, much to the joy of our central bank. But I think that's a shame that we have a central bank that seems to view that devaluing our way into prosperity is the way to go. I don't know where that's worked in the past for very long. It benefits a select group in the economy, and those winners, of course, are quite happy with a falling dollar. But for most Canadians, particularly those on fixed income and poorer Canadians, it's a real kick in the teeth. So the good news, I think, is that we're closer to the end than we are at the beginning of this. I mean, I can't imagine the Bank of Canada trying to drive the dollar down to 50 cents. I mean, nothing would surprise me with this current Bank of Canada regime, but we would hope that they will be reasonable in their cheerleading here for a lower loonie, and that at some point they'll let the loonie find its own floor and not cheerlead it down any further than market forces will take it. Now, I think that in terms of the oil price, with Western Canada Select under $20, how much further can we go, right? I mean, we're getting close to that ultimate barrier of zero. Now, I don't for a minute believe that oil is going to zero, but the point being is that we're closer to the end of the fall than we are the start. Now, that doesn't mean we're going to get a rebound either anytime soon, or the oil price could trade in a consolidating pattern for years. It could trade in a consolidating pattern for months, or it could be weeks. We don't know at this point. And the good news is, I think, we're getting close to the end of this, and that should hopefully put a floor on the currency, put a floor on the collapse of purchasing power of Canadians, and should put a floor on the Canadian stock market, because once Canadians and investors start to believe that the loonie can no longer go much lower, the incentive to invest offshore will be taken away. Foreign investors will look to Canada, and the Canadian dollar will be finding some more friends than it has right now, and along with that, Canadian investment.
Has the low loonie helped make BC real estate more attractive to Asian buyers?
Well, absolutely. I mean, there's always winners under any kind of move in capital markets, and it's the big winners are offshore real estate buyers, or buyers of any Canadian assets, who are willing to step in and stomach the volatility. So, interestingly enough, a big winner has been a major Canadian real estate investor, RioCan, which is a commercial REIT focused primarily in Canada, but they also have a number of U.S. investments. And what they've announced is that they're selling their U.S. investments and going to bring their Canadian dollars back home. And the CEO, Edward Sunshine, called the collapse in the loonie a happy accident for them, because they're now able to sell their U.S. investments, and they're going to bring their U.S. dollars back home to Canada and reinvest it into their Canadian properties. So, yes, if you're looking to invest in Canadian real estate, This has been a golden opportunity, and now we'll have to see, though, how the events in China impact the local Vancouver real estate market and the Toronto real estate market as well. There's two ways this could go, and maybe they could offset each other. But on the one hand, you've got the low dollar, and you've got a problem in China with confidence with respect to future investment opportunities. So that could drive more money offshore into Canada and to other places. On the other hand, it's unclear how much this turmoil in the Chinese economy and the Chinese financial markets reflects the liquidity problem with investors, and there may be a need for some investors to repatriate some money back to China to pay off debts, or it may just cut off a lot of avenues for potential future Chinese investors in foreign real estate. They may just not have the means of financing to be able to do that. So that's the multi-billion-dollar question for 2016, particularly in Vancouver. And I think everyone will be watching the spring home sales, particularly on the west side of Vancouver, to see how they compare, particularly the volumes to last year, and that'll give us probably our first early indication of how the China turmoil is impacting the local real estate market.
What kind of impact is or will the new real estate rules have on mortgages that go into effect next month?
Well, that's a great question, Jim, because what didn't get noticed last week in all this turmoil was that the Royal Bank increased mortgage rates in Canada. And this comes at a time with falling bond yields. So all I can surmise from that move is that the recent regulatory tinkering by Ottawa has had some impact, and we may be at the bottom of mortgage rates. Now, if the global economy falls off its wheels here in 2016, anything's possible. You could see a reverse lower, but there is still this issue of credit risk with a mortgage. It's pretty secure in terms of a lender looking for an asset to lend against, but it's not like a government bond. So there's always a risk that even if government bond yields go lower, mortgage rates could still tick higher if credit risks globally and in Canada start to widen, and that often happens in an economic downturn. So we could be at the bottom of mortgage rates, but again, in terms of Vancouver, until we see any sort of reluctance of foreign purchasers to come into the market, I can't see any factors right now that would shake up the local Vancouver real estate market dynamic, because I just don't think mortgage rates are while they may be heading higher, I don't think they're going to be heading substantially higher in the next few months. Certainly not in time for spring shopping season. But certainly the trend, though, may be over in terms of having the tailwinds from low mortgage rates. What's very interesting is since the Fed raised interest rates on December 16th, we've seen a reversal in some multi-year trends. Since 2011, when the Fed started what was known as Operation Twist, where basically it went in and bought long bonds and sold short-term bonds, what it did, it put a lid on commodities, and it lit a fire under housing in the U.S. So if you've gone short gold stocks, and if you've gone long U.S. home builders, or real estate, for that matter in Canada, you have done very well. The gold stocks are down 2/3 since that period, and home builder stocks have doubled. So more than doubled. So that has been a great trade. However, that trade's gone into reverse since December 16th, and we'll have to see if that continues. Ever since 2011, gold stocks have been on a one-way street down. But ironically, in the first week of the new year, in 4 out of those 5 years, gold stocks outperformed the market, and they've done it again this year. Now we'll have to see if things are different. It's kind of been a first-week winner's curse for gold stocks, and so all eyes will be on whether they can maintain their momentum that they've seen in the first year. But given that the Fed has raised rates and that maybe we're moving into a different monetary policy dynamic now, where investors can no longer just assume that it's a one-way bet that the Fed is going to raise rates because they've already started raising rates. There's now more uncertainty towards the long-term future path of U.S. monetary policy. So it's kind of counterintuitive, but the more the Fed raises rates, the less likely it is they'll be raising rates even more in the future. So as an investor, you're always trying to be one step ahead of where the policymakers are going to go. So this rate hike by the Fed has been anticipated for years by the market. Gold stocks have been sold off for years in anticipation of this Fed rate hike. Now the Fed rate hike is here. We may get a couple more depending on how the data evolves, but this is probably the beginning of the end of this gold bear market, and we'll have to see whether 2016 marks a turning point. A lot will depend on how the Fed responds to incoming U.S. data, including inflation data.
What does it do when the Royal Bank of Scotland declares sell everything, prepare for disaster?
Well, it depends when they issued the warning. If they're doing it this week, it's probably a little too late. So if they sent that notice out to Chinese investors in May of last year, then that would be well timed.
But of course, the headline is today.
Well, there you go.
Ted, I mean, so many experienced people in the markets were saying for quite some time that it was a good idea to liquidate, take cash, and wait for things to bottom out. How come so many people didn't follow that advice?
Well, when we look at insiders and they've been selling in the U.S. for years and they've been early. Now, part of that is because they often get their stock at very low cost basis. So even though they leave money on the table, they still make a profit. People really, once they see that they've got a gain in hand, it's worth a lot to them. And parting with that gain is, psychologically, it's very hard. So it is hard to sell when you believe that stocks could keep going up. And it's even harder to buy when you see stocks going down. For example, I don't know very many people who are bullish on the Canadian stock market right now. And, now is probably a good time to start looking at the Canadian market, at certain, resource companies, not necessarily buying right now, but start putting a shopping list together because they're so disliked and no one globally is interested in Canada. Well, that's the time where you can find some bargains. It's impossible to find bargains, for example, in U.S. social media stocks right now, even after the last sell-off. Sure, Facebook may continue to move higher with virtual reality. Netflix with its global expansion, sure, it may be able to continue higher in 2016. But these stocks are not cheap. They're not bargains, and they have every likelihood of going down as they do going up with the Fed raising rates. So we're in a highly uncertain period in the U.S. market where in many cases, the average stock, I believe, in the U.S. is already in a bear market, but you could even have the possibility of seeing some of these high flyers enter a bear market. I'm not saying that's what's going to happen, but they could end up there. We're in Canada. We are in terms of the S&P TSX composite, we are in a bear market. So far, our mid-cap oriented Canadian Insider Index has managed to skirt it, but the chances of that holding out for the next week or so, are probably slim. So I think the Canadian market has already had a lot of bad news discounted. So that would suggest that looking at opportunities in Canada is, now would be a good time to start sniffing around. And if you have long equities in the U.S., if you haven't started selling some of them, taking some money off the table, now is probably a good time. But it doesn't mean there's no value opportunities globally. And certainly, the more fear there is in the market, usually the more buying opportunities there are. But of course, one has to live within their risk tolerance, and if you can't take the volatility of losing money for a few weeks or a few months, you probably shouldn't be in the stock market at all, because no matter whether you're invested in the U.S. or Canada, we are going to be in for some volatile times over the next few weeks and months. I think eventually this is going to settle down. I think the China situation It's got a lot of attention in the first week, but that's a more, I believe, a symptom of the great financial crisis than a cause of the next one. I know there's some others who believe that China is a crisis in the making. Hopefully that will not be the case, but there's always a risk. But when sentiment is down and when sentiment is lousy, when everyone's selling, it's usually the time you want to start thinking about buying.
Well, we all know the old saying, buy low, sell high, and yet so many people do the opposite.
It's human nature, especially when you see losses. It's very hard to stomach those losses, so you want to get rid of them as fast as you can. And there is of course something to be said for having disciplined stop losses. There's nothing wrong with that. But if you're unable to stomach any loss in the stock market, then it's probably not the vehicle for you. And unfortunately, there aren't very many vehicles right now that are not susceptible to losses. So short of cash, which when the Fed is raising rates, it's not always a bad place to be. So the cash is going to become more attractive if the Fed continues on its rate path, even if the Bank of Canada goes off and does another rate cut, which will accomplish absolutely nothing for the economy, but nothing would surprise me again from the Bank of Canada these days.
Well, every time the Bank of Canada cuts rates, the loonie falls again. It doesn't need any more help down, does it?
Exactly. I mean, right now, currency traders, rightly or wrongly, perceive the loonie as a petrocurrency. It's going to move with oil until fundamentals reassert themselves at some point, where in fact, Canada does have more going for it than just the oil price. So, having the central bank get in and try and distort markets with another rate cut, what do they want to do with another rate cut? Like prop up zombie oil and gas companies in Alberta? I mean, what are they going to accomplish? We've already seen that chartered banks are unable to pass through the full rate cuts in the past, the last two, to borrowers. So I'm not quite sure what the Bank of Canada hopes to achieve aside from distorting markets and sending the currency even lower to help a select group in the economy. And in the process, again, the poor are going to get hurt very hard because they're the ones who spend most of their income on food, which is most susceptible to a depreciating currency. So we've got a huge wealth transfer that the Bank of Canada engineers whenever it does this. It's never held to account properly, in my view, for what it does. It's not an elected body. If you're going to redistribute income, let's have the elected politicians do it with a mandate and not leave it up to the central banks to take from the poor and give to, certain well-off groups in the industrial sector.
Could Canada declare that it's going to peg its dollar to the U.S. dollar?
I doubt that would happen. There's been absolutely zero indication from the Bank of Canada, from the Minister of Finance, and it would have to be a Ministry of Finance decision that this is in the works. And I mean, there is a lot to be said for a free-floating currency. I just wish it were free-floating and that central bankers wouldn't try and manipulate the direction of the currency. Let the market find its own levels. You don't need central banks to jawbone it up and down, provided that the central banks aren't in distorting markets to begin with.
Well, it seems every time governments decide to manipulate markets, in the end, it just makes everything worse.
Well, we've seen that in China, haven't we, in the last few months? So, and to some degree, we have a much smaller example of this going on in Canada with the currency. Every regulator tries to manipulate markets to some degree, and the hope is that they're doing it for positive outcomes. So, I mean, that's a whole other, discussion in terms of how interventionist should the Bank of Canada go. But the fact of the matter is there are winners and losers under any of these scenarios, and as in, for investors, they have to be aware of, who the winners are and who the potential losers are. And if I'm right and the Canadian dollar is closer to the bottom than it is its top, then, things should be looking up for the Canadian stock market for the next for 2016, maybe not in the first not in the first few months, but it wouldn't surprise me to see the Canadian market outperform the U.S. market here. And how the real estate markets unfold, though, could be a different matter, and a lot may depend on what happens with foreign money flows into the Canadian real estate market, and there are a number of factors that could be driving that. So we'll just have to wait and see how that unfolds.
Ted, thanks a lot for chatting with us.
Well, it's great to be back, and once again, Happy New Year, Jim.
Well, it's Merry Christmas and Happy New Year for people in the Orthodox community, happening right now. Like my Ukrainian friend said, we're pretty smart, you know. We get all the Boxing Day sales and pass the savings on to the family. Thanks again, Ted. My guest has been Ted Dixon, CEO and co-founder of InkResearch.ca, Canada's first online financial news and research service. You're listening to HowStreet.com Radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. Comments can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.